Morning guys, Joel here, market analyst for YouTrading, and today we're taking a look at gold. Now I've got gold here on a daily, and you can see pretty much for the last year, or maybe not for the last year, since last August when we hit these all-time highs above 2,000, gold has been gradually falling in this descending trend channel. We've got three good touches at the bottom. We've only really got two touches at the top, so that downtrend isn't really confirmed just yet, but I think it's definitely an area a lot of market participants are going to be looking at. So as you can see, if we look at gold over sort of a more recent time horizon, you can see after it posted this double bottom, that was in March. That double bottom was in March. Well, gold's actually been doing quite well. It's rallied back above 1800. It's kind of stagnated a little bit. It wasn't really able to get above 1850, but that's potentially also some selling pressure coming in ahead of this descending trend line here that I was just talking about, this one here that I'm moving around. But the dollar is looking like it's a bit on the ropes, like the dollar index is just above 90. If the Dixie does drop below 90, and if US real yields, which have been falling recently, which has also been helping gold, if they continue to fall further or at least remain low, then the sort of fundamental backdrop for gold to potentially test this trend line and break above it is pretty good. So, I mean, if we do break above it, what areas have we got to look at? Well, let me just get a rectangle out and I can start drawing them. So you got this late January, early February level of resistance here. That's between like 1880 and 1860. You want to be looking out for that. If we can break above that and break above the 1900 level, which itself will be a key level to watch, well then you've got the annual high from this year, which is just above 1950, and then also a high from last November as well. That's the big steep daily drop over here, by the way, this one. That was on when the news came out that the coronavirus vaccines were effective. So potentially, if we start clearing all of this, we could be getting back to that. But that would require further dollar weakness, as I've been saying, and for real yields to at least stay at their current levels or perhaps even push a little bit lower. So what could potentially cause that? Well, there is definitely a theme that a lot of people have been talking about. It's been a hot topic this week. I kind of already spoke about it yesterday in the video that I did talking about the NASDAQ, and me and Nev spoke about it in the weekly podcast, but inflation in the US and globally, but there are fears that inflation is going to be higher and more persistent than what the Federal Reserve thinks is going to be the case. Because basically, we're all expecting this rise in inflation because this time last year, obviously, price pressures were very, very weak because of the first lockdown and the pandemic, and that first lockdown really hurt the economy and prices fell in a lot of instances. So you've got this weak base effect. So the year-on-year inflation in May and April and June is expected to be high purely because of weakness last year. But also there's growing concerns not about weakness last year, but about price pressures right now. You've got all these supply chain disruptions that have been being reported in these PMIs for the last couple of months, and we all know about this global chip shortage. The latest NFP report also suggests that there's a shortage of labour, even though there's all these people that are unemployed at the moment. For whatever reason, perhaps it's because benefits too generous, perhaps it's because of fear of the virus, perhaps it's because of childcare burdens. But either way, there's a lot of things that are stopping people from going back to work, which is potentially going to put upwards pressure on wages. So there's a lot of these price pressures around at the moment. And despite all of this, the Fed is trying to say that, inflation is just going to be transitory. We're going to ignore inflation pretty much. We're going to focus on trying to get the unemployment rate back down. And if they're right, and inflation does go up for a bit and then it comes down to normal levels, and then, you know, the unemployment rate continues to drop and all that kind of stuff, then happy days. But if they're wrong, well then if they're wrong, this is where things could be really good for gold, because you've got an ultra dovish Fed with interest rates at zero, continuing with its QE and all this kind of stuff, and high inflation. Remember, gold is a hedge against inflation, but gold also loves really accommodative central bank monetary conditions. So that's almost a perfect storm. And as fears grow that might be what happens, well then you're looking at gold potentially moving higher. And I mean, depending on how bad these inflation fears get, and fears that the Fed is going to be dovish despite high inflation, we could even go back to these all-time highs. I mean, that's a big call, and bond yields could move higher, and that could spoil the party and send gold lower again. But we're just going to have to wait and see. It's a very interesting one. Hope you all enjoyed the video, and I'll see you all in the next one.